Silver just crossed $85. And yet, if you listen to Wall Street, nothing important happened. No emergency alerts, no breaking news banners, no primetime debates asking what comes next. That silence is not accidental. Because when silver moves like this, when it breaks a level that held for decades, it exposes something much bigger than a price chart. It exposes stress inside the financial system, pressure inside currencies, and cracks inside the paper markets that most people never see. Here is the uncomfortable truth. Silver does not move quietly without a reason. This metal has a history of staying asleep for years, sometimes decades, and then waking up violently. When it moves, it does not ask for permission, it does not care about analyst price targets, and it certainly does not wait for retail investors to feel comfortable. The $85 level is not just another number, it is a psychological wall, a credibility test for the entire paper silver market. For years, investors were told silver was boring, too volatile, too small, not relevant compared to stocks, crypto, or even gold. Meanwhile, demand was building quietly. Industrial use kept rising, physical supply kept tightening, governments kept printing, and the gap between real metal and paper promises kept growing wider. Now that gap is starting to matter. Wall Street would rather you focus on daily noise, CPI prints, Fed speeches, stock market rotations, anything that keeps attention away from a simple question. What happens when a real asset breaks free from artificial pricing? Silver is not just a precious metal, it's an industrial necessity. It sits inside solar panels, electric vehicles, medical equipment, data centers, military hardware, and advanced electronics. Unlike gold, most silver is consumed. It's not neatly stored and forgotten. Once it's used, it's often gone forever. That creates a problem when demand accelerates. At the same time, mining supply has not kept up. New discoveries are rare, production costs are rising, and many silver mines are actually byproducts of other metals, meaning supply does not respond quickly to price changes. This is not a setup built on hype. It's a setup built on physics, economics, and time. So why is Wall Street quiet? Because silver exposes uncomfortable realities. It questions the strength of fiat currencies. It highlights inflation that official numbers smooth over. It challenges the idea that paper claims equal real assets. When silver breaks a level, to understand why silver just broke $85, you have to ignore the surface explanations. You will hear talk about speculation, momentum traders, or short-term demand spikes. Those explanations are comfortable, but they are incomplete. The real drivers are structural, slow-moving, and far more powerful than most investors realize. Let's start with physical demand. Silver demand today is not driven by jewelry or coins alone. It is driven by industry. Solar energy is one of the biggest forces here. Every solar panel requires silver, and there is no efficient substitute at scale. As governments push aggressive renewable targets, solar installations continue to grow regardless of economic cycles. That creates a steady, price-insensitive demand base. Electric vehicles add another layer. EVs use significantly more silver than traditional vehicles. Charging infrastructure, power management systems, and onboard electronics all rely on silver's conductivity. This demand is not optional, it is built into the design of modern technology. Add data centers, medical equipment, defense systems, and advanced electronics, and you get a picture most investors miss. Silver is no longer a niche metal, it is a critical input for the modern economy. Now look at supply. Global silver mining has struggled for years. New discoveries are rare, permitting takes longer, and costs continue to rise. Energy, labor, and regulatory pressure all push production costs higher. Even worse, many silver mines are not primary silver mines. They are byproducts of copper, lead, or zinc operations. That means silver supply does not respond directly to silver prices. Even if silver doubles, supply does not suddenly flood the market. This creates a dangerous imbalance. Demand grows steadily while supply remains rigid. Over time, that pressure builds. Eventually, price has to adjust. But physical demand and supply alone do not explain the speed of the move. The real accelerant is the paper market. For decades, silver pricing has been dominated by futures contracts, derivatives, and paper claims. These instruments allow massive volumes of silver to trade without physical metal ever changing hands. In calm markets, this system works. In stressed markets, it breaks down. When confidence is high, paper silver is treated as equivalent to physical silver. When confidence cracks, investors start asking uncomfortable questions. Can this contract actually be delivered? Is there enough metal behind these claims? As prices rise and volatility increases, those questions get louder. At higher prices, some holders of paper silver demand physical delivery. That puts pressure on inventories. At the same time, industrial users secure supply more aggressively, unwilling to risk shortages. This creates a feedback loop. Less available physical metal leads to more stress in the paper market, which pushes prices higher. This is where $85 becomes critical. Now that silver has broken $85, the real question isn't just why it moved, but where it could go, and how investors should think about this move. Understanding the pattern is crucial because this is not a normal market swing. This is a structural adjustment, a rare alignment of supply, demand, and financial stress that can accelerate prices faster than most expect. Let's start with what typically happens after a breakout of this magnitude. Markets don't move in straight lines. Silver will experience sharp swings, green candles followed by sudden red pullbacks. Headlines will try to explain every dip as a correction or overbought, but these short-term moves are distractions. The underlying trend is determined by fundamentals, industrial demand, physical supply constraints, and pressure from paper markets. Investors often make the mistake of thinking volatility equals risk. It doesn't. Volatility is the language of the market when it is adjusting to a new equilibrium. Risk is misunderstanding why the adjustment is happening. If you focus on the fundamentals, the metal being used in solar panels, EVs, electronics, and industrial applications, you see why price swings are signals, not threats. Another common mistake is chasing momentum. Once silver crosses a psychologically important level like $85, retail investors in smaller funds are tempted to jump in out of fear of missing out. This is exactly what Wall Street anticipates. Experienced traders know that early positioning, discipline, and patience matter more than chasing headlines. The early movers who understand supply-demand dynamics capture most of the upside before the crowd even notices. What should disciplined investors watch right now? Start with inventory levels. Exchanges like COMEX and physical bullion dealers provide data on how much metal is actually available. Shrinking inventories indicate that physical demand is outpacing supply, which could fuel further upside. Then monitor industrial usage reports, solar, EVs, electronics, because they act as an invisible floor for prices. Currency trends are equally important. Silver often moves in inverse correlation to the US dollar. When fiat currency confidence weakens, precious metals benefit. With rising debt levels and persistent inflationary pressures, silver is positioned to outperform if these macro trends continue. Sentiment analysis is another critical tool. Right now, sentiment is still in the disbelief phase. Analysts, commentators, and institutional players are cautious, downplaying the move. Historically, the biggest gains come during this phase.
Now that we've broken down why silver just broke $85, how it moved, and the forces behind it, the final step is taking disciplined action. This isn't about hype, guesswork, or chasing headlines. It's about translating knowledge into strategy while staying calm in a volatile market. First, positioning is key. If you're considering exposure, think in layers. Don't buy all at once. Spread entries over several price points, taking advantage of pullbacks. This approach reduces risk while keeping you in the trend. Remember, silver is volatile, and even structurally strong rallies experience temporary dips. Layered exposure protects capital while letting you benefit from long-term structural drivers. Second, diversify within the space. Consider combining physical silver, ETFs, and maybe silver-related mining stocks. Each has pros and cons. Physical silver gives direct exposure, but requires storage and liquidity management. ETFs are convenient and liquid, but may not fully track tight physical markets. Mining stocks carry operational risks, but can outperform in rising price environments. A balanced approach ensures you're not overexposed to any single risk. Third, focus on data, not headlines. Watch COMEX inventory levels, industrial demand reports, and currency movements. These metrics provide early signals about the strength and sustainability of this breakout. Avoid being swayed by emotional commentary or sensationalized reporting. The market moves fast, but informed investors move faster. Fourth, respect volatility. The $85 mark is psychologically and structurally significant. Expect swings above and below this level. Use volatility to your advantage. Pullbacks are opportunities, not failures. Discipline in execution beats panic-driven trades every time. Now, here's a critical mental shift. Don't equate short-term noise with risk. True risk is mispricing or misunderstanding the underlying fundamentals. Silver's move is driven by industrial necessity, constrained supply, and monetary pressures. If your analysis aligns with these drivers, temporary dips are part of the journey, not a reason to exit. Engagement with the market also requires patience. This rally may take weeks or months to fully play out. Early adopters may experience periods where the trend feels stagnant. That's normal. Remember, structural moves don't follow